Alright guys, so this week matters. The structure of the market has shifted. Nasdaq pushed into late January resistance, failed to break through, and has pulled back roughly 4% over the past month. That is not a continuation, that's a hesitation. When the index stops trending cleanly higher and starts compressing near support, capital rotates. Some names stabilize and some break down. This video focuses on three stocks positioned differently within this environment. For each one, I will be breaking down what the company actually does, why it matters right now, and the bull case scenario, the bear case scenario, the key technical logic levels, and my positioning logic. I'm Luca, I study finance, and every week I analyze market setups through fundamental sentiments and technical structure. This is not financial advice. So let's get into the video. Okay, so for the first stock, we are coming in hot with BYD, Build Your Dream Car. BYD is not a single segment EV manufacturer. It is vertically integrated industrial group. It designs and manufactures electrical vehicles, batteries, power semiconductors, and energy storage systems. Vertical integration reduces supplier dependency and protects margins during pricing cycles. That structural advantage is central to the thesis. BYD has become one of the largest EV manufacturers globally by unit volume. It sells both battery electric vehicles and plug-in hybrids. Unlike many Western competitors, it operates at scale in multiple price tiers, including mass market segments. International expansion is accelerating. Deliveries outside China are increasing, particularly in Europe and Southeast Asia and Latin America. This reduces reliance on one domestic demand cycle. Battery manufacturing capacity is a core strategic asset. The Blade battery is designed for cost efficiency and safety performance. Internal battery supply stabilizes cost structure relative to competitors dependent on third-party suppliers. Revenue growth has been strong year-over-year, supported by rising vehicle deliveries and product mix improvements. Okay guys, so the gross margins have held stable despite industry-wide pricing pressure in China. That margin resilience reflects integration and cost discipline. Operating leverage improves when volume scales across integrated production lines. This creates margin expansion potential if pricing stabilizes. So why does it matter now? The stock had a strong move higher before this pullback. Now it is not crashing, it is simply moving sideways and slowing down. That is important. When a stock goes up strongly and then pulls back quietly on lower volume, that usually means investors are holding their position. It suggests the stock is resting, not being sold aggressively. Right now, BYD is trading between a clear support level and a clear resistance level. Support is the recent low where the buyer stepped in, and resistance is the recent high where the seller showed up. The range is getting tighter. That means pressure is building. If the stock breaks above resistance with strong volume, that usually leads to continuation higher. If it falls below support, then short-term downside opens up. Now let's talk about the bull case. Global demand for electric vehicles is still growing over time. BYD is expanding outside of China into Europe and other regions, which reduces dependence on one single market. Because BYD produces its own batteries and key components, it has better control over their competitors. If China introduces economic stimulus that could also support domestic car demand, the main argument for BYD is simple. They have scale, they have cost control, and they produce at very large volumes. Now, the bear case, which I don't believe in, but if this happens, if China's economy slows down more than expected, consumer demand for cars could weaken. There's heavy competition in electric vehicles, especially pricing pressure in China that could reduce margins. There are also geopolitical risks that could impact exports, and because this trades internationally, currency movements can affect the share price. Also, if the global market moves into risk-off mode, even strong companies can fall in the short term. That's important to understand. But BYD is a strong company. but it still trades with global market sentiments. If the overall market holds support and starts moving higher again, industrial growth names like BYD can benefit. If the market breaks down, cyclical companies usually feel pressure first. This is not a hype stock. This is a production-driven company. Its strength comes from manufacturing, depth, and supply chain control. The long-term story depends on continued demand growth and cost leadership. Okay guys, for the second stock, I'm picking SoundHound AI. This is the high volatility AI name on the list. It does not move slowly, it moves in bursts. As of the latest close, Sound is around $7.46. Now here's the reality. This stock is not priced like a normal company. It's priced like a growth story that needs to keep proving itself. Right now, the market is valuing SoundHound at roughly 3.1 billion market cap, with about 148 million in annual sales, which is why price to sales multiplier is high, around 21 times the sales. So if you're buying sound, you're not buying steady, you're buying execution and momentum. What does SoundHound have? SoundHound builds voice AI, conversational AI, the kind that can run inside cars, restaurants, call centers, and voice commerce. This is use AI to talk to customers type of business, not sell GPUs. Why does this matter this week? Sound is one of those names that reacts hard to two things: market moods and AI headlines plus earnings expectations. And there's a third factor here that can make moves violent. Short interest is huge. As of latest reporting data, Sound has about 123.4 million shares sold short, which is roughly 32% of the float, with about 5 days to cover. That matters because if price starts running and volume expands, shorts can get trapped and you can get a fast squeeze. The fundamental story: SoundHound has shown strong revenue acceleration recently. In prior In a prior strongest ever quarter, revenue was reported at 43 million, 217+% year-over-year, and they raised a full year revenue outlook to 160 and 178 million at the time. So in between those two numbers. They also guided 2025 revenue in the 175 million and 177 million range in earlier, which is basically the market pricing into continued rapid growth. So the setup is simple. If growth stays hot, the multiple can stay high, stocks can run. If growth disappoints even a little, the multiple compresses and the stock drops hard. So the technical setup. Look at recent tape. Sound traded at around $8.83 and $9 earlier in the week, and then sold down to $7.46. So our key zones are $7.40, where support and the resistance is at around $9. So bull case scenario: AI sentiment rotates back into smaller names, short interest creates squeeze potential, and any strong earnings guidance updates can trigger up repricing. Bear case, said bluntly, valuation is expensive relative to revenue. That's what we already discussed, and it's not consistently profitable yet. If Nasdaq breaks support, this type of stock gets hit first. This is my take. This is a tactical momentum setup. This week, the only thing that matters is price plus volume. If it holds above 740 and pushes back above 880, $9 with volume, the momentum trade is back on. If it loses support, you don't argue with it, you respect the downside. Okay guys, so now let's move to number 3, PayPal. This is not a momentum stock. This is a re-rating or value trap decision. And the line between those two is execution, where the stock is now. As of the latest quote, PayPal is around $40 per share. That's not a cosmetic detail. It tells you the market is pricing PayPal as a mature payments utility with elevated competitive risk, not as a growth compounder. At this price, PayPal trades on a low teens PE based on current earnings, about 13 times on the tape. So the debate is simple. Is it cheap for a durable cash generator, or cheap because core franchise is structurally weakening? When PayPal went down last week, the sell-off was primary earnings plus outlook plus leadership shock. On February 3rd, 2026, PayPal reported for Q4 results and issued a weak 2026 outlook, including guidance that implied flat down profit progression and pressure on key profitability metrics like transaction margin dollars. At the same time, PayPal announced a CEO change, naming Enrique Lores and to take over as CEO, effective March 1st. Markets hate two things: weak forward guidance and leadership turnover during a turnaround. That combination is why the stock reset lower, not fake macro talk. What PayPal actually is. PayPal is a global payments platform with multiple engines: branded checkout, Venmo, Braintree, and the critical point, not all parts are equal. Braintree can grow volume while putting pressure on take rate. Branded checkout is higher value, and this is where PayPal has been fighting to regain momentum. I will look at two case scenarios. So the first one is the bull case scenario. Why this could be a buy here. The valuation already assumes disappointment. At $40 and 30 times earnings, the market is not pricing in a heroic turnaround. If PayPal can deliver simply less bad, stable volumes, modest margins resilience, you can get upsides from multiple expansions. The cash generation still matters. Management guide to $6 billion plus adjusted free cash flow and $6 billion of buybacks for 2026. At this market cap, that's not trivial. It can meaningfully reduce share count and support EPS, even in slow growth environment. And the final point, if execution stabilizes, the stock doesn't need high growth to work. A re-rating can happen with stable revenue, steady transaction margin dollars, credible improvements in brand checkout trajectory, and reduced execution noise. This is the quality at discounted price bet, but it requires proof. Now, let's look at the bear case. Brand checkout remains the pressure point. Recent commentary and reporting make clear the company has struggled to re-accelerate the brand experience, particularly versus strong competitors at the commerce service area. Second point, 2026 guidance is not confidence-inspiring. PayPal's own outlook suggests limited near-term earnings growth and pressure on transactional margin dollars. Cheap stocks can get cheaper when guidance signals stagnation. And finally, the CEO turnover raises execution risks, not lowers it, at least initially. A leadership change may be necessary, but it also introduces uncertainty around strategy, pace, and accountability. What would make a good moment to buy? Specific triggers. I currently think this is a very good moment, but this is what I'm also watching to see what will happen. So a branded checkout growth inflection, transaction margin dollars stabilizes, credible 2026 narrative from the incoming CEO, and no further downward revisions. PayPal at $40 is not a hype opportunity, it's a prove-it opportunity. If execution stabilizes, the valuation leaves room for meaningful re-rating. If branded checkout continues to drift and margins stay pressured, the stock can remain cheap for a long time or reset even lower. So this week is not about prediction, it's about reaction. The Nasdaq rejected resistance and pulled back. That shifts the framework from momentum chasing to level watching. BYD is structural industrial scale. It depends on execution and global demand durability. SoundHound is momentum and positioning. It depends on sentiment, short interest dynamics, and volume confirmation. PayPal is stabilization and repricing. It depends on margin, discipline, and multiple expansion. Three different profiles, three different risk structures. If the market holds, supports, and volume expands, continuation setups become valid. If support fails, capital preservation matters more than conviction. Price confirms this. Guys, this is not financial advice. This is my opinion, and this is how I am currently looking at these three stocks, and this is why I will be investing in these three stocks this week, after when the market opens again. If you like this video, if you got some information you found interesting, please like the video, subscribe, and could you please also comment what you think about it and what I should improve.